There's a small form sitting inside your bank account right now. It asks a single question, it looks completely routine, and almost everyone who sees it fills it out without a second thought. That one form, and what happens the moment you submit it, might be quietly costing you more than any fee your bank has ever charged you out loud. Here's what makes this strange. Banks spend enormous resources collecting this information. They engineer clever ways to ask for it. They dress up the request to feel like a service. And then, here's the part that should make you pause, they often don't even verify what you say. Think about that for a moment. They want the number badly enough to ask for it persistently, but not badly enough to check if it's true. That tells you something important about how they're actually using it, and by the time this video ends, you'll understand exactly what that is, and you'll never look at a financial form the same way again. I've spent a long time studying the mechanics of how financial institutions make decisions about customers, not what they say publicly, but what the data and the business model actually reveal, and the income question is one of the most misunderstood interactions in everyday banking. Section 1. The classified ad you placed about yourself. Every time you voluntarily update your income with a financial institution, you are placing a classified advertisement about yourself, and you're not controlling who sees it or what they do with it. Think about how a retail store works. When you walk in, they see you, your clothes, your behavior, your body language. A good salesperson reads those signals instantly. Now imagine if, instead of letting them observe you passively, you handed them a laminated card listing your exact salary, your job title, and your recent financial decisions. You've just changed the entire interaction. That's what happens when you update your income voluntarily. The moment that number enters a financial institution's system, it doesn't sit quietly in a file, it activates. Algorithms that were treating you as a generic account holder suddenly have a high-resolution data point to work with. You get recategorized, your profile shifts, and the offers, terms, and attention you receive start calibrating to that number in ways you'll feel but never fully see. This isn't a conspiracy, it's a business model. Banks segment customers. They allocate resources, design offers, and set pricing based on what they know about each individual. More data means more precise segmentation. More precise segmentation means more effective extraction. Income is the single most valuable input they can collect because it tells them not just what you have, but what you can be made to spend. The unsettling part? Most people hand this over freely, on request, because the form looks official and the question feels routine. That normalcy is not an accident. It was designed. Section 2. The pricing trap that only works on people who can afford it. Here's where things get genuinely counterintuitive. A higher income doesn't just change what products banks offer you. In specific situations, it raises what they charge you. You'd assume the opposite. Higher earners are lower-risk borrowers. Lower risk should mean better terms, and sometimes it does, but there's a layer underneath that logic that most people never reach. Banks don't just calculate your risk, they calculate your sensitivity. There's a fundamental difference between will this customer default and will this customer notice if we charge them more. Sophisticated lending algorithms run both calculations simultaneously. A customer earning $220,000 is statistically less likely to default, but they're also statistically less likely to spend 45 minutes researching competitor rates, call in to negotiate, or switch providers over a 2% difference. They're busy. They have more financial complexity to manage. Their time is expensive. The inconvenience of switching exceeds the cost of accepting slightly worse terms. Banks know this. They model it. The practice even has an internal name in financial analysis: ability to pay pricing. The premise is simple: charge what the customer can absorb, not just what the risk warrants. So when you update your income upward, you may be doing something you never intended, signaling that you're a customer who can be priced more aggressively with minimal consequence. Stop and sit with that for a second. You shared your income to get better service. What you may have gotten instead is a quiet reclassification into a customer who can be charged more. Section 3. The principle of data decay and why stale information protects you. Here's an original idea that almost never comes up in these conversations. Information has a life shelf, and inside a bank's algorithm, old data doesn't just become less useful, it becomes less dangerous to you. Banks build predictive models. Those models are only as accurate as the data feeding them. Fresh income data, updated last month, is a powerful input. It's current, it's relevant, it shapes algorithmic decisions with high confidence. The bank acts on it. Data from 3 years ago? Far less useful. Life changes, income shifts, circumstances evolve, the algorithm becomes uncertain, and uncertainty in risk modeling generally produces conservative default behavior rather than aggressive optimized behavior. Conservative default behavior usually means standard terms, standard offers, and significantly less targeted marketing pressure. This is why banks don't just collect income once, they ask repeatedly. They send update requests. They engineer pop-ups, calls, and forms designed to refresh the data continuously. Every update you provide doesn't just inform them, it resets the clock. You become freshly classified. The algorithms engage. The targeting intensifies. When you decline to update, the clock keeps running, the data gets staler, the model becomes less confident, and you quietly drift toward the kind of undifferentiated, low-key treatment that the bank reserves for customers they can't clearly profile. You didn't do anything dramatic, you just didn't volunteer, and that silence, that data gap, ended up working in your favor. Section 4. The armor you already own. This is where things flip completely. There's a form of data that banks can't simply ask you for that speaks louder than any income figure you could report, and you generate it automatically every time you use your account. Your behavioral data. Payment history, account longevity, utilization patterns, how you respond to offers, whether you carry a balance, how often you log in, when you call. All of this is observed, recorded, and weighted continuously. Banks don't need your permission to collect it. They don't need you to fill out a form. It emerges from your actions. Here's what makes this significant. Behavioral data is harder to manipulate and harder to game than stated data. Banks trust it more. It reflects what you actually do, not what you claim to say. And consistently strong behavioral signals, paying on time, keeping utilization low, maintaining accounts for years, produce a financial profile that no income figure can override. There's a practical implication here that most people don't fully appreciate. If you pay consistently, keep your balances low, and maintain long-standing accounts, you are already telling the bank everything that actually matters. You're demonstrating reliability in the only language that can't be faked. What you earn is a claim, how you behave is evidence. The customers who need income data to look good to a bank are often the ones whose behavioral data is weak. If your behavioral data is strong, the income question becomes far less consequential, and withholding it costs you almost nothing while reducing your exposure to segmentation-based pricing. Your actions have always been your best argument. Most people just didn't realize they were already making it. Section 5. The Practical Playbook. Let's make this concrete. Knowing all of this is only useful if it changes what you actually do when the next form appears. For new credit applications, provide income. It's essentially required for approval, and there's no practical way around it. But be intentional about what you report. If your income is variable, freelance work, project-based income, or seasonal fluctuations, you're not obligated to report your highest possible number. Report accurately, but don't pad it with optimistic projections or one-off bonuses. The application asks for income. It doesn't ask for your most favorable interpretation of income. For mid-relationship income update requests, the pop-ups, the emails, the friendly calls, these are almost universally optional. There's no consequence for closing the window. No account will be closed. No credit score will move. The bank will ask again in a few months. You can decline indefinitely. Each time you do, the data staying in their system gets a little older. That's not a problem. That's working exactly as intended. For credit limit increases, ask yourself one clear question before responding. Do you actually want a higher limit? If the answer is no, declining is the correct move. If you want the increase, providing updated income may be necessary. That's a fair trade. Just make sure the trade is actually serving you, not just the bank's interest in knowing more about your financial position. For any loan that legally requires income verification, mortgages, certain auto loans, provide exactly what's required and nothing beyond. They'll specify what documentation they need. Give them that, full stop. And when the request comes by phone, remember that calls are designed to create urgency and social pressure. The voice on the other end sounds like authority. It isn't. You can simply say you'd prefer not to update that information and end the conversation. Nothing will happen. The discomfort lasts about 30 seconds. The benefit lasts as long as that data stays fresh in their system.